Good afternoon, everybody. It's Monday, the 20th of April, in a week where we saw the unemployment rate spike to 22 million people. It seems like 4 or 5 million people per week being added to the unemployment numbers. It was shocking to see that our predictions are actually too conservative. I was worried that they were maybe too aggressive. I'm going to talk about a few things today that are important to the residential real estate market, the commercial and industrial real estate market, the construction market, and then finish up a little bit, some update on some deals that we're working on. The mortgage market, I'll start on that first. People have been asking me why we're not seeing more distress in the mortgage market. And I think the answer is we're seeing plenty of distress in the mortgage market, just not compared to the stock market. The stock market reports daily and the mortgage market really only reports monthly as first of the month payments come due. That tends to be 80% of the payments. So you don't see any flow through to the, for example, Black Knight data for 2 or 3 more weeks. I think where we are, one of my earlier sessions, I suggested that we were in a position where we were retracing the steps of the 2008 crash, and I think that's looking more and more likely. There was a period in late 2008 all the way to 2009 where, while real estate prices were flat, the rest of the market was crashing around everybody's ears. And I suspect we're seeing the same thing again, simply because the sort of trades that I'm seeing in the marketplace that are closing are only premium quality assets, and they're being sold 10 cents off, 20 cents off. And that's for stuff that was typically trading at a premium just weeks before the current pandemic. So I think we'll see a reenactment of that. We are currently in the calm. The storm is only just beginning for real estate. And I think we'll see that in a couple of places. Distressed debt is one of the key places. And so I follow Oaktree pretty closely. And being a good Irish Catholic, I chuckled at this headline from Housing Wire that the markets without bankruptcy is like Catholicism without hell, in that there is a cleansing process and a brink that must be pushed back from. But Oaktree are a $125 billion fund, and they've been very active. It's well known in the marketplace, buying up distressed assets. They tend to focus mostly on business, so operating businesses, but the same parallels can be drawn, I think, in the residential market, although that may not play out for some months yet. Where we are seeing distress immediately, though, is across every bank on commercial and construction loans. These are the first loans to go bad, particularly I'm living and working in Lower Manhattan, and you'll see as you walk around the streets in the evening a shuttering on just about every piece of construction. These loans go bad very quickly. Cost of construction in New York is extremely high. Capital values are extremely high. Taxes are extremely high. So you fall behind on a loan that is not working perfectly. If your site is not working perfectly, you can get into trouble very quickly. And we're seeing more than 1,000 banks across the US, and that's not just in New York, but across the entire country, have more than 90 days late construction loans. And you can imagine on a $50 or $100 million loan, the interest rates on those loans are typically 6, 7, up as high as 10%. You can get upside down on that deal very quickly. I think you'll see that across a lot of construction, and I'll do a much more detailed review when I have more data. This is just to the end of March. You can imagine when we include April or May's data in that analysis. And what you also saw, this is again just the very end of April, mortgage-backed securities, particularly non-government paper, a lot of forced selling. So we saw 15% increase in sales, much higher than what we would normally see for an average week, which tends to be around the $3 to $5 billion of sales. Also looking at landlords, commercial landlords, people like related, 80% of their tenants just not paying. And indeed in New York, which is a democratic state, tendency towards more power to the people type thinking, there's talk of a rent strike being organised for May, which will be just horrendous. We're already seeing a lot of regulation on commercial multifamily, which had prior to the collapse been trading at a 5 cap. We'll see those caps expand way higher. I think they could get to 8, 9 or even 10 cap rates, because if people are not paying their rents, again, those kind of commercial buildings which typically had very low delinquency rates is only going to expand. I said to you in my last update, we thought that the areas where we would see the most distress on the residential real estate side would be around the coasts, anything to do with oil, and in any high priced markets. And indeed that's what we're seeing. We're seeing distress in second homes. Anything over $1 million just is not trading. There is no buyer for that. We have 6 or 7 deals, live deals right now, that have all stalled because of mortgage financing, lack of availability. We're also seeing in the Northeast, and any deals there just gone quiet. We expect 1 or 2 to close this week, but they're unusual situations in that they're very high priced properties, very well capitalized buyers using very low levels of debt. Similarly, anything that's related to oil, tar sands, Bakken, the Dakotas, expect to see wide ranges of bankruptcies in all of those markets. And anything to do with leisure, I read the governor of Nevada trying to get Las Vegas reopened because the economy there is hurting. You can imagine what Las Vegas is like right now with just nobody there, or many hotels closed, and trying to get back to business there. That lack of revenue will mean a lot of distress coming in the coming weeks. This is brand new data from DV01, an analytics firm, but showing exactly what I suggested a couple of weeks ago, that the distress would be in the high price markets. Now we're actually seeing distress in every market, but that has not yet flowed through to the residential market. That's still on the mortgage side. We also spoke a little bit about FHFA and their suggestion that up to 2 million people could seek forbearance. Well, what actually has happened is it's already at 3 million people, and I think we're going to get much higher. We could get to 5 or 6 million people seeking forbearance. And while that sounds like an interesting fact, it's actually an enormous problem for the residential market and also for the mortgage market. And I'll do a video later on to explain why that is. But in a nutshell, part of the servicing agreements on these mortgages requires that the loan servicer must advance the principal and interest, whether or not the borrower is advancing it. Most mortgage servicers are in fact just servicing companies. They don't have a lot of assets. They don't have a hefty balance sheet. They're not in a position to advance those payments, and I expect to see a rash of delinquencies and bond collapses and servicer collapses in the coming weeks, unless the Treasury steps in and supports some of those institutions. So that's all I have for you at the moment. I'll do a bigger update later in the week. I'm going to compare the mortgage market to the overall debt market and the stock market. We talk about the stock market all the time, but it is only 50% the size of the bond market. So we need to be focused on where the debt is much more than where the equity is. That's all for now. I look forward to speaking to you later in the week. Have a great week, everybody.